Hello, everyone, and welcome to Thursday Talks with Chug. Each week, we cover pressing topics that matter to you and your business. I'm Ariana Gonzalez from Chug Attorneys and CPAs, tuning in from our San Diego office. Please join me in welcoming partner Jyoti Javeri from our Santa Clara office. Hi there, Jyoti, and welcome.
Hi, Ariana. Thank you for the warm welcome.
Thank you so much for being here with us today. For today's topic, we're going to be talking about turning financial data into business decisions. Just a quick disclaimer before we get started. This conversation is for informational purposes only and does not create an accountant-client relationship. So if you do have questions, please email us anytime at info@truth.com so we can help you out. So let's get right into it, Jyoti. How do you define the difference between accounting and strategic financial analysis?
Great question, Ariana. So I would say accounting tells you what happened. It records your business activities accurately and ensures compliance. Versus strategic financial analysis goes a step further. It interprets the data to explain why it happened and what to do next. Think it of like accounting as your car's dashboard, and strategic financial analysis is like a GPS that helps you decide where to go and how to get there more efficiently. So that's the key difference between the two.
And what would you say are some overlooked financial reports that can provide deeper business insights that we might not probably know?
Yeah, I mean, many times many business owners generally just focus on profit and loss, but there are a lot of other reports which are very informative. So, like cash flow statement shows whether profits are turning into real cash. Product or customer segment profitability reports reveal which products or clients are actually profitable. Even like an aging report highlights the collection or the payment bottlenecks. And lastly, we could think of budget versus actual variance analysis. That helps to explain the performance gaps. So these help uncover the inefficiencies or any hidden growth opportunities that a business could have.
And why would it be important to understand all three of these financial statements and not just the profit and loss one?
Yeah, that's important. The profit and loss shows only profitability, but the balance sheet actually reveals the financial health, like it shows your assets, debts, liquidity. The cash flow statement shows the sustainability, whether your business can keep operating smoothly. Together, they provide like a 360-degree view. You could be profitable on paper, but running out cash in reality. So it's very important to look at the overall 360-degree view.
Yeah, great points there. So we have a lot of clients who are small and medium-sized businesses. So what would you say are some key financial indicators that those small and medium-sized businesses should be tracking?
Sure, yeah. So, for those kind of businesses, ideally they should monitor the gross profit margin, which basically measures the pricing power and the cost control. The next could be the operating cash flow, which indicates liquidity and operational strength. Accounts receivable days, it shows how fast you could actually collect your cash. Inventory turnover could be another one, which reflects efficiencies in your managing your stock. And lastly, I could think of is the customer acquisition cost and lifetime value, which is basically critical for growth planning. These metrics form the backbone of strategic decision making.
You mentioned how it can reflect efficiency. So can you share a little bit about how financial data and uncovering can uncover inefficiencies or even hidden opportunities?
Sure. So when we analyze properly, the numbers actually tell stories. So let's take an example. A low margin product may be consuming too many resources. Customers who always delay payments might not be worth the risk. The other one could be cash flow trends can reveal opportunities to negotiate better supplier terms. By drilling into the data, a CP or an accountant helps you identify the quick wins and avoids wastes. So that's how you would analyze it better to understand your real picture.
Can you share a little bit about how cash flow statements can guide better operational decisions?
Sure, sure, Ariana. So, cash flows show where the money is truly going. If operating cash is low despite the good sales, it definitely shows some signal poor for poor collections or excess inventory. Monitoring this helps businesses plan purchases, manage their payroll timing, and forecast funding needs. So a 13-week rolling cash forecast is one of the most powerful tools for a short-term financial control.
We have clients in almost every industry, and the people who watch our lives are also in different industries. So, how do you help clients determine which numbers matter most for their particular business?
Yeah, bang on question, Ariana. Not every metrics fits for every business. I mean, everyone needs to analyze it differently. We first identify the key drivers, what truly influences the profitability or growth. For example, a service firm tracks utilization rates, while a retailer tracks the average order size and inventory runs. So the goal is to focus only on the metrics that tie directly to those strategic outcomes. So you need to analyze it business to business.
And how can monthly or quarterly reviews turn into actionable plans? What's your advice here?
Yeah, no, it's very important to have quarterly reviews to be on track. And, so each review should go beyond reporting to action planning. Identify what changed and why. Choose 3 to 5 actionable insights. Assign ownership and targets and timelines. Follow up next month for accountability. Financial reviews should drive progress. It should just not be compliance. So that's how you should actually read your quarterly reviews or reports.
In simple terms, can you help us understand the difference between forecasting and budgeting?
Sure, sure. So a budget is something that sets your goal for the year. It's your plan versus forecast updates that plan based on your new information. It's your real-time reality check. Smart companies use both budgets for direction and forecast for adaptation.
And what about scenario planning? How could that help during economic uncertainty, for example?
Sure. So scenario planning prepares your business for what if situations. By modeling best, base, and worst cases, you test how changes in sales, costs, and interest rates affect the cash flow. This lets you make decisions proactively, cut costs, adjust the pricings, or even delay capital investments rather than, react in the crisis mode. So look at all these and then jump into your decision.
For everyone wondering how an accountant can help with this, can you help us understand how an accountant can use historical data to forecast future growth or even risks for your company?
Sure. So, ideally, what we do is historical trends actually reveal a lot of good patterns like seasonality or sales cycle that guide realistic forecasting that could help you to picture your forecast in a better way. A CP or an accountant can spot leading indicators like slowing receivables, shrinking margins that predict your future slowdowns. So, this allows you to adjust the strategy before the problems actually hit you.
Great insights. Thanks for sharing that. From your perspective, what financial red flags might suggest that a business could need to pivot?
Yeah, there are quite a few key warnings that we would look at, um, which include like consistent revenue growth, but shrinking profit margins. The other one would be rising accounts receivable or inventory with no increase in sales. High customer concentration, like, too much of reliance on one client, or declining cash reserves despite, you having stable sales. Addressing these early prevents small issues from becoming existential threats. So that's how you would look at it.
I want to ask you a little bit about technology. I know it's changing by the day and, more and more is becoming available to us. So, how is that changing an accountant's role in strategy and what they do for their clients?
Oh, that's a brilliant question, Ariana. I mean, everyone's eyes are on this right now. So technology automates bookkeeping and reporting, freeing CPAs to focus on the insight and the strategy. But modern tools like QuickBooks, Power BI, all these AI-driven analysis help the CPAs or accountants provide real-time dashboards and predictive insights. The result faster decisions and more forward-looking advice from business owners. So everyone's into AI and trying to use it more efficiently and effectively.
Definitely. Thanks for sharing that with us. What about for those of us who aren't financial leaders? Are there any tools or dashboards that you would recommend for non-financial leaders to keep an eye on?
There are quite a few, Ariana. I mean, user-friendly dashboards that I could think of is Fathom, Life Plan, Power BI, Google Data Studios. They help to translate, the complex data into visuals that help the non-accountants to make better decisions or confident decisions.
Is there any way that automation can improve accuracy and decision making from what we know so far?
Yeah, of course. I mean, automation reduced a lot of manual data entry and errors through tools like, automated bank feeds, invoice scanning, reconciliation alerts. So this saves a lot of time, which were earlier manually done. So accurate and real-time data means owners can base directions on facts, not on outdated reports. So it also frees a lot of time from gives you a lot of time to strategic work and instead of just doing the data cleanup and doing things manually. So yeah, it definitely would improve efficiency.
Absolutely. We love to hear that. So we get a lot of clients who come to us for both of these things. So can you help us understand the difference between compliance accounting and strategic advisory for those who may not know?
Sure. So compliance accounting focuses on accuracy, taxes, and reporting. Strategic advisory uses financial data to improve operations, pricing, long-term planning. So think of compliance as keeping a score and advisory as helping you win the game. So that's the little difference between compliance and advisory.
A lot of people wonder what the golden number is for how often they should meet with their CPA or accountant. So, how often should business owners be meeting with their accountant? What's the golden number here?
Sure, Ariana. Again, this depends from business to business, how much is the volume of each business. So, at the bare minimum, monthly to review their key financials, any cash flows, quarterly, if they want to revisit their budgets, forecasts, strategic priorities, and annually, of course, you could plan your taxes, investments, and growth. So I would say regular meetings create accountability and ensure the decisions, stay driven, are data driven basically. So if you meet the CPAC and the accountants at good intervals, it will help you make good decisions.
And for anyone who might be on the hunt for a new CPA or accountant, what questions would you say business owners should ask to get the most value from their accountant?
Good question. That's a tricky one actually, but yeah, generally what you could hear is what three numbers most affected my results in this month, or something like where do you see the biggest opportunity for improvement? What financial risks should I be watching? Or it could be like, how can we use this data to grow smarter next quarter? So asking the right questions turns your CP into a strategic partner, not just like a tax preparer. He could help you and advise you accordingly.
Thank you. And do you have any advice for how business owners can improve their financial literacy?
Um, I would say start small, learn one financial term or a ratio each month, review your financial statements monthly with your CP or your accountant, take online workshops. There are several available in the market, which are so easy and AI driven now, which or a CPA led sessions focused on your industry. So over time, understanding those numbers transform how you lead and grow your company.
Absolutely. I have one more question for you, Jyoti. What would you say is the first step to start turning numbers into strategy today?
Great question, Ariana. I would say begin with focus. Pick 5 to 8 key metrics that truly reflect your goals. Like it could be margin, cash flow, DSO. Review them weekly and assign accountability. Create a 13-week rolling cash forecast. And once you start using data consistently, insights will naturally drive smarter decisions. So that's what I could say here.
Thank you so much for all of your time today, Jyoti, and answering all of our questions on this topic. We really appreciate it. And thank you, everybody, for joining us today. That is all we have time for today. So, this brings us to the end of our conversation. Please subscribe and follow us on Facebook, LinkedIn, and YouTube. If you have any questions or suggestions, feel free to email us anytime at info@chook.com. We would love to help you out. And make sure to join us back here next week for more pressing topics that truly matter to you and your business. Thank you so much, everybody. Take care. We'll see you
Thank
soon.
you.
Thank you, Jyoti.
Thank you, Ariana. Thank you, everyone.